Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. I hope everyone's having a great Tuesday morning. Let's go ahead and get started. We have quite a bit to cover here today, but before I do, just a quick disclaimer. What we're going to discuss here today is purely for educational purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So let's first off start off by talking about where the market is. Not a whole lot has changed since we talked last Tuesday from the perspective of the overall markets are still sitting right near around that 292, 293, stuck between that 285, 302 zone that we've been talking about for quite some time. We did say that above 285, this market is more of a bullish stance, which puts us in the environment where we generally want to buy the dips that we see. There haven't been a lot of big dips, usually no more than 1-2% at the most, but if you did buy those dips, you tend to be doing okay on the option side. With this current market environment, generally speaking, we prefer to be selling premium because volatility is still relatively high compared to what we had back in January and February. It certainly is much lower than what we had at the very bottom of the sell-off where the VIX was trading in the 70s and 80s. VIX is now trading at 26, well below 30. But this type of calm makes it actually better for us to be selling volatility because we're not seeing huge directional moves that can potentially offset the gains that we have from shorting volatility. So whether we're selling puts, covered calls, cash secured puts, and even credit spreads, those are the types of strategies that we prefer to be using with respect to options in this particular market. So we expect to continue to see a bit of a slug in between buyers and sellers, but we certainly think that at this point that we're going to get a retest of around 302, which is a pretty major resistance level here if you go back to the weekly charts. And just to reference again some of the things that we've discussed over the past few weeks is that last year we spent a lot of time between 283 and 302. Basically, almost 6 months was spent in between these two levels. So you have a lot of accumulation of buyers who had bought stocks in this particular range. And as the stocks kind of rally into this range, you tend to see a lot of sellers because people who had bought equities are trying to get back to break even. They're trying to sell their stocks at break even. So you get quite a bit of selling here, and then you have the Fed effectively buying everything in sight, which pushes continuing asset prices higher from the downside. So you have these two selling pressures from investors who have bought from all the way from April to November of last year versus the investors currently buying right now. If we do get a break above 302, that's really when things can get quite overextended and overheated. But until we get above 302 right now, our position is that markets are going to continue grinding higher. Now, it's important that we also look at not just the S&P 500, because I do think that when you look at the S&P 500, sometimes things get masked and the picture is not as clear. That I think it's better sometimes to look at something like the NASDAQ 100 index or the Qs, because the Qs have been significantly stronger. The Qs are back to where we were trading right before the February sell-off. Now, the thing I want to point you to as far as the Qs go is you have this major resistance level around 229. This was a gap that we had on February 21st to the February 22nd. You had that gap lower, and it's just about to approach and fill that gap. So normally you might see a bit of a pullback as you hit that gap. The question right now is to whether this stock can break above that 229 level and get back to our 52-week high, or our all-time high, rather, around 236, 237, which would be, I think, a pretty phenomenal result given where we currently stand. We certainly would be at peak valuations if that is the case for us to resume back to 237, 238, because you effectively are trading at the same price with significantly lower earnings for the companies that are in the NASDAQ 100 index. So if we do make it back up there, you're trading at a substantially more higher elevated valuation at those levels. So that's something to pay attention to, but technology remains one of the strongest sectors here. Today, we're going to take a look at some of those sectors. And on the flip side, you have small caps that have really not participated in this rally at all. It's still trading below its 20-week moving average. 20-week moving average coming in around 135 or so, we think is going to act as a pretty strong resistance. As you can see, 135, you've had this bit of a double top here. You've had a double top, got rejected. Looks like it's going to try to make another run at 135. If it can break above 135, certainly small caps will join the rally here. But overall, small caps not joining on this particular rally, looking particularly weak for the overall market. So again, this speaks to the bifurcation that we're seeing in the markets. This is the theme that we've been talking about for a couple of weeks now. And this is the theme that we're going to actually continue, because to invest in this current environment, it's important to look at what's working, what's not, because there's a clear bifurcation between the two. And you should try to position for both sides if possible, especially when markets are just kind of grinding higher. So as markets continue to grind higher, there are clear signs of exhaustion, right? So in the daily charts that I've shown you in both the S&P 500 and the Qs, there are strong levels of resistance that we're coming up against. Each time we get near those resistance levels, the market seems to sell off. It's not able to push through those resistance levels with any real certainty. And momentum is really starting to wane, and there isn't some strong momentum pushing this market higher. But there are no signs of reversals. This is really the key part, right? Many times you look at these types of exhaustion, you look at the markets are hitting resistance levels, and you think that, oh, it's time to short the markets. We don't have any indication that we are approaching some kind of risk off. There isn't a clear catalyst as to what's going to drive the markets lower right now. So we don't suggest that you go out and buy some put options on the market, or even though it's relatively cheap. I know we've been getting a lot of questions from clients over the last few days. Is it time to start buying puts? We don't think so just yet, because just because there are signs of exhaustion does not mean the markets cannot continue to grind higher for quite some time. That is our base case at the moment. Now, we do think that eventually you might get a bit of a sell-off here, but as far as what's that catalyst that's going to trigger that sell-off, and the indicators that we look at to tell us that the sell-off has started, we don't see any of those signs just yet. But this is a bit of a deja vu from what we've seen back in late January, early February. We're kind of in that state right now where you kind of say you don't want to fight the Fed. Markets keep moving higher, even though the fundamentals have decoupled from where the markets are trading. I would say far more now than it was back in January and February, where the economy was still was very strong. Right now, the economy is significantly weaker, despite the fact that we think there's going to be a fairly quick recovery on this, relatively compared to other recessions or recessions of this type of magnitude. But the indicators are there. Right now, we are not in this state where we think the markets are going to reverse lower, not just yet. Now, some of the things that we use to determine that: number one, the VIX. The VIX contango. VIX is back in contango. The front month VIX is trading at 26. 3-month VIX is trading at 30. So you have the front month VIX trading below the 3-month VIX, which is telling us the markets are not particularly fearful in the short run. This is the indicator that we typically look at to tell us that risk is off and that it's time to start buying puts in the market. We are not in that state. Oil has been relatively stable, still trading in this particular case well into the 20s. Brent is down a little bit today, so perhaps we're seeing a little bit more volatility out of oil. But crude, still trading at around 25. So this stability is certainly helping the market continue to stay stable. Also, high yield. This is something that for those of you that follow options action, this is something that I've put out a trade on for this particular week. High yield has been very stable. It's been sitting between the 78 and 80 level. I'm looking for a breakout to the upside above 80, but as of right now, it's sitting inside this range, and it looks like it's trying to test the upper bounds of that range and hopefully trying to break out to 82 and 84 to the upside. This would certainly be a bullish indication for the market. So those are all the things that we're currently watching that provide us with the thesis that we don't see a catalyst or a risk of the market selling off in the near future and warrants us to go out there and buy puts. Now, this could change fairly quickly. Some of the data that we're currently looking at with respect to COVID-19 provides some possibility of a risk. I would say the risk right now is still relatively low, but things can change pretty quickly on that. It certainly did back in late February, so it could potentially change here. But as of right now, our base case is still that the markets are going to grind higher. So today we're going to take a look at some of those sectors, but the trends continue to improve. We looked at this last week, and I think there were about 13 or 14 states where the number of cases were still increasing. That number right now is down to just 8 states where you have cases that are still growing. The number of states where the number of cases are flat, I believe, are 27. And then where the states are decreasing is 18, I believe. So this number continues to improve. Last week, this was in the 11 or 12, so that's decreased down to 8, which is great. Most of those have joined this particular group of cases where they are mostly the same. And then you have 18 states at this point where the number of cases are declining, with New York being the primary one for us to focus on. New York being the primary one, being the largest of the states with the number of cases. So trends continue to improve, and the country is sort of a little divided at this point. And I think Elon Musk's tweet last night really kind of embodies this, where you have workers that have lost work for quite some time, going on 2+ months now, and businesses that want to resume, weighted by the fact that you have the risk of reopening too early and having a second wave. We see some of those risks in other countries right now where they've kind of reopened up, whether you're looking at Iran, whether you're looking at Korea, where they are starting to see explosion of cases. Granted, those explosion of cases are fairly contained to a small group, and many of these countries have had good testing in place. But then you have plenty of other countries like Iran that doesn't have that type of testing. Brazil, same thing, trying to reopen their economy, but seeing a significant influx of cases. How is this all going to play out? I think that is truly the risk that we see that could send the markets lower, is we reopen too early, you get a new explosion in cases, and all of a sudden you have to potentially close down portions of the economy again. That, I think, is really the catalyst that could move the markets lower. I'm not saying that's going to happen, but that is the risk that we currently see. So Elon Musk trying to get back to work while the country and the county tells them not to. That's the struggle that we're going to see over the next few weeks with respect to different countries and cities opening up. Now, I want to point us to some of the data that we're seeing as far as reopening trends. There certainly have started to, we're starting to see some of the data to show slight improvements in certain things, whether it's retail sales, a slight bump in retail sales. This is Morgan Stanley's indicator for retail sales, starting to see some improvement there. When you look at survey data showing how many people are comfortable with going out to eat in the next 2 to 5 months, that data is continuing to decline, with number of people saying that they feel comfortable going out starting to increase in terms of going out 6 months or so. So as these start to converge and start to cross each other, that's really the type of indicator where we are looking for that states that people are getting more comfortable with the idea of going out. But I want to be very clear that the hard data that we're seeing with respect to states such as Georgia that have reopened their economy, the data is not particularly strong. We're not seeing this strong uptick in activity. Rather, the activity is still pretty flat. And I think that is really realistically what we're going to see, because most of the survey data that we're seeing certainly is improving, but not by a significant amount where when states reopen, you're going to see this huge uptick in numbers. It's just not happening. Pretty much all of the states that have reopened have seen fairly flat business activity, even though they are quote unquote open. And I think this reflects how people in the country really feel about how comfortable they are getting out there, even if their state says it's okay, go out there and, or reopen non-essential businesses. I think people are still taking this very, very slowly and seeing how things play out before they go out. And I think that's the challenge that we're really going to see, because the markets have effectively priced in more of a kind of spike in activity once states reopen, but we're not quite seeing that right now. So I think that's part of why the markets are not rallying on this type of good news either. It's really just continuing to grind higher and test out the waters, if you will, especially with the Fed continuing to pump liquidity. That's going to drive small moves higher in the market, but we're not seeing major moves. So with that, what I do want to point out again is some of the surprising strength that we're currently seeing in the market. So discretionary, consumer discretionary, being one of the stellar sectors or industries of the market. Now, prior to the sell-off, prior to coronavirus, the discretionary sector was extremely strong because 70% of our economy or our GDP is driven by consumer spending. So we know that the COVID-19 has had a significant impact in consumer spending or consumer sentiment. We would expect the discretionary to be fairly weak, but we're not seeing that. Discretionary has rebounded, actually more than the S&P 500 has rebounded from its lows. So that is the strength that we're currently seeing from discretionary spending that is, I would say, a bit surprising to us. Now, it is trading up against a major resistance level around that 118 level here, which coincides with the 200-day moving average. If it can get above that 200-day moving average and come back to retest that, that certainly brings us towards that 125, potentially even 130 high here. But I will say that again, pushes higher here has not been confirmed by momentum. Momentum continues to move lower here, and there's a fair amount of, I would say, overboughtness, if you will, of this particular market, given the fact that it's rallied quite a bit off its lows without any real checkbacks. It had one initial small checkback, and then it's pretty much just continued moving higher since. And it's maybe gearing up for another move higher, but it's really hard to say right now. But I will point you to another sector that is a leading right now in this particular sector, which is the retail strength. Now, consumer discretionary has a lot of names in it. The one thing about just the consumer discretionary sector, XLY, is that XLY is predominantly consists of two stocks, Amazon and Home Depot, both of which have been extremely strong. Versus retail has been generally weaker because it incorporates a lot more of the retail space, hasn't included it doesn't have as much weight for Amazon and Home Depot, but retail has really started to come back to life over the last few weeks. And one of the things I wanted to point out is this $38 resistance. And if we can break it back above it, I certainly think that we have the resumption of retail moving significantly higher. As you can see, this 38 level is a major resistance level on the weekly chart. We tested this back in December 2018 low, tested it again back here near June or so. So now that we broke below it, we're looking to see if we can break back above it. If we break back above it, this could bring us all the way back up to that $46 level. If it gets rejected, then there certainly are a lot more downside to the downside. But so 48 is a very critical level to keep an eye out here for retail. So interesting sub-industry to look at within the discretionary play. But again, discretionary and consumers, surprisingly strong, and this is one of the sectors that we definitely want to pay attention to investing in this particular market. On the flip side, financials remain extremely weak. This is, I wouldn't say this is surprising at all, given the fact that if you look at interest rates, we are trading at effectively all-time lows as far as U.S. interest rates. This is going to put downside pressure on most of the financial institutions that rely heavily on on interest for their revenues. So predominantly, if you think about the major banks, the regional banks, these are sub-industries within the financials that are fairly weak. But financials itself overall, which obviously includes a lot of different types of financial institutions, everything from payments like credit cards to banks to insurance companies, still trading below a fairly major resistance level here, which is the December 2018 lows. It tried to break up above it, but it hasn't, and it's consolidated below that $23 level for quite some time now. And 21 is a major support level. It's been trading between 21 and 23. If it breaks down below 21, we certainly think that there's further weakness here. But I do want to point you to a specific industry, a sub-industry within financials that also is looking even weaker, which is insurance. Insurance, if you think about the regional banks that predominantly rely on interest for their revenues and making loans for their revenue, those are the stocks that off the surface would look like they would be the weakest. But insurance companies are actually significantly weaker compared to the banks right now. Has not been able to make a move back up to that $28 high. This looks a little weaker. There's a higher probability that insurance companies might actually break that support a little sooner before the whole industry does and starts to move a little lower. So we're really paying attention to this insurance business. This is KIE, which is the S&P insurance ETF for the S&P insurance index. So this is a sub-industry within the financials that we're looking at that is particularly weak. So when we're searching for opportunities as short, when we're searching for opportunities on stocks that we don't think are going to move higher and sell call credit spreads on it, these are the types of industries that we want to focus our attention on. And lastly, healthcare. We wanted to point us towards healthcare again because we've been following healthcare for quite some time. We've been talking about the strength. It is the strongest sector out of most of the sectors recently, but that has started to shift a little out back into technology, because technology was the strongest sector for the longest time. But during the initial check back, healthcare became the strongest sector. But over the last few weeks, healthcare has really started to over the last few weeks, healthcare has really started to move sideways while technology continues to move higher. So there is some sector rotation out of healthcare. As you can see, momentum is actually moving lower as this ETF continues to move higher. But we are watching healthcare. If it breaks above 102, that brings us back towards, a check back to 105, which is the all-time high here for XLV. But again, within healthcare, we are seeing certain strengths. Biotech really took off yesterday. This is something we have been talking about for weeks, and I've been talking about this 123 level as a major support level here for IBB. We've been talking about it ever since it broke above 123. It's been basing for quite some time, broke down below it for just a couple of days and came back, and that was a great entry signal to go long. And the ETF has rallied up to 133, which is back to its July 2015 all-time high. So 113 is a major level for us to keep a look at, because if we go back to 2005, if we can get this breakout above 133, this is going to take off and potentially have significant gains to the upside. So very important level to keep a lookout for, because XLV, the whole healthcare sector, while starting to rotate out a little bit back into technology, we're seeing some very strong gains within the biotech space. And there's some names that I want to point us to. Eli Lilly looking particularly strong in this particular sector. Similar chart pattern to IBB, but hasn't broke out to all-time highs just yet, based around 152 or so. I would say 160 is a pretty significant resistance. If you can get back above 160, I certainly could see some momentum moving higher here in a strong stock like Eli Lilly, where money flow remains extremely strong throughout these rallies, which is a good indicator of potential breakouts here. Same thing for Bristol Myers. Bristol Myers not as strong as Eli Lilly, but certainly also similar type chart layout, broke trading between 60 and 63 or so, with some resistance back up to that 68. So if you do get that breakout higher, you might see a move higher up into that 68 level here. So right now, these are the different names and sectors and industries that we're looking at, specifically sub-industries within the sectors. Right now, the sectors, if you just look at the sectors as a whole, generally speaking, there isn't a whole lot of action. But if you look at individual subsectors, we do see quite a bit of opportunity here as we start to see rotation out of certain sectors. Like industrials and financials, and even energy still looks pretty weak right now, back into strong sectors like healthcare, technology, and even discretionary, which is a bit surprising to us. And potentially that could be the unraveling. That might be where you see the best opportunities to short if and when the market does turn around. But again, we don't see that. We don't see that happening right now at the moment. All the risk on, risk off indicators are back into risk on. So at this point, our base case continues to be this market is going to grind higher, buy the dips, sell some premium right now, collect premium, sell cover calls, sell credit spreads, sell short puts. Use that premium that you collect now to buy puts if and when the market do correct from, and I'm not here to speculate as to what's going to cause that or what's going to be the catalyst for that sell-off. But if and when that happens, you're going to need some premium to buy those puts. You want to collect the premium now to try to buy those puts eventually. So with that concludes what I wanted to share with you guys here today. Looks like the markets are about to open up slightly higher here. Not a surprise to anyone. This is predominantly what we've been seeing over the last few weeks. It seems to continue to find signs of exhaustion. Volume seems to have leveled off a little, because for quite some time we saw declining volume. Volume has been fairly stable to roughly pre-coronavirus levels. So again, continuing to see those types of signs of stability in this market, but we're expecting that this market's going to grind higher up until that 300, 302 level here. So I hope that this was useful in helping you set up your day, thinking about what sectors are moving, where we see strength, where we see weakness in the markets, and hopefully that helps you provide a few ideas for your trading day. So thank you so much. I hope you guys have a great Tuesday and happy trading, and I'll see you guys next week.